Hi, this is Jim Sackman, your focal point business coach. And again, we're working on the Way to Wealth formula, again, popularized by my friend Brian Tracy. And I want to talk a little bit more about COGS and OPEX. Last week, we talked about these topics in how they worked on the income statement, but I want to really talk a bit more about how they work inside your business. So that's what we're going to do this week. And really, it's all about understanding your expenses. One of the most important things when you're a business owner and when I've been an executive and we look at this, expenses are the one thing that is really under your control. You can't make people buy your products, but you can choose how much money you're going to spend. Now, there's always, needless to say, you're going to say, hey, well, there's some minimum I need to spend on some things like insurances and rent and that. Yes, but in general, expenses are directly under your control. Revenue is not. The second thing is unlike revenue, expense drops straight to the bottom line. What do I mean by that? So if you think about a revenue dollar, you've got to take off the percentage for cost of goods sold. So let's say you've got a 50% gross margin percentage. That means for every $2 you sell, you get $1 in profit. If you save $1 in expense, you make $1 in profit. So in some ways, it's better to save money than it is to make money. Now, caveat there, you can't save yourself into growth, but what you can do is evaluate what makes you profitable. Because remember, profit is your objective, not revenue. Now, there are some companies that will say, we're in a land grab mode for market share, and we're going to spend every dollar we make in profit growing the business. And I understand that, but even in that mode, you need to be looking at the current things that you're doing. Are you doing them in such a way that makes it very effective for you to grow? Because the more money you could save off current business, the more money you could put into expanding your top line revenue. Let's talk about COGS, cost of goods sold. The primary way that a lot of product companies deal with improving gross margin or reducing cost of goods sold is cost reduction. And that can be done by either finding a cheaper way of building a product or a cheaper way of sourcing it. So if you're somebody that doesn't add, it just resells some other person's product, you need to look at negotiating with vendors. Can you get a better deal? And in some cases, that can have to do with terms and conditions, not strictly with price. Can you get them to bill you on a longer term? Whatever it is, some way that you spend less money, that you finance your customers less for every dollar you spend out the door. Second one is premium pricing. So this is where the whole marketing and branding thing comes in, as well as looking at the products you actually offer. If you look at your products, can you derive a premium in particular in a specific target market, which is why we talk about target markets? Can you charge more? Now, when I say that affects COGS, it affects it as a percentage. It doesn't really reduce your costs, but what it does do is it allows you to charge more for the same dollar spent. So you improve your gross margin percentage, which from my standpoint provides you more gross margin dollars, which looks like in a lot of ways a cost reduction. There's plenty of ways to do that. Provide premium features, provide interesting features, target individual versions to individual types of customers, and find premium brands to work with. Those are all kinds of things you can do to provide premium pricing. And your goal is to get into the mid 40% range. So if you've got a business that, and there are some businesses that thrive very well on extremely thin gross margins, in particular through distribution and very high volume consumer sales, but the average business, you want to have at least 45% gross margin. There are services business like coaching, like what I do, where it's much higher than that. But for a product business, if you can have 45% gross margin, then you'll have enough left over in the business that you've got money to spend to grow and operate the business on an ongoing basis. So that's a reasonable goal for almost every business. Again, there are businesses that fall outside of that, but that's a pretty reasonable goal to get started with. Operating expenses. the most important thing here is looking at business processes. That is I talk about management in terms of products, process, and people, and we'll get to people in just a second. But processes are that midterm thing that you can do to change the way that your business operates. And if it operates more efficiently, then you will get more money for the money you spend. Let me use a simple example from my past. We used to do purchase requisitions for equipment by hand, and then we turned it into an automated system, so it sped up the process, took less time. Fewer people needed to be involved in manually processing the forms. They were recorded, it was tracked, the whole 9 yards. It saved a bunch of money. We didn't lose control. We just executed the same thing we had more effectively. There are also times, bigger changes, where you change the way you do business and you can save even more money. So that's one thing to look at, business processes. But a bigger element of OPEX is people. In most companies, operating expenses are 70% driven by the number of people you've got. So do you have good ones? Are they effective and trained at what they do? Are you providing them feedback on what you want from them? I spend a lot of time with customers recently talking to them about the effectiveness of their people and how they manage them, what they do to get them on track, how they can make them even better employees for themselves. One of the beauties of it from the employee standpoint, by the way, if you haven't thought about this, if an employee is making you more money, you can afford to pay them more. So there's an incentive for them as well to improve their performance. And finally, there's a goal of 7%. And what is that 7% goal? That's a 7% year-over-year improvement in OPEX. If you remember from last week, I told you that if you stand still, you end up with about 7% less money year over year for a business to just stand still, same people, same processes, same products. Next year, you're going to make the same amount of revenue, you're going to earn about 7% less profit. So what you want to do is, that doesn't mean you have to lower cost by 7%. It means you have to be 7% more productive. Can you improve your gross margin dollars? And that's really the target, is the combination of increasing your gross margin dollars and 2, reducing your operating expenses. Can you get a combination of that to improve about 7%? If you do that, then that's break even for the year, right? That sounds terrible, but that is the goal. That's why we're always looking at growing revenue and why we're looking at saving money. So that's what I want to talk about today. This is Jim Sackman from Focal Point, and you change your business and you can change your life.